Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth, and today we are going to look at some market trends. I've got 6 different market trends we'll look at real quick. It'll give you kind of a scope of where we are as we start the new year, and I hope this will kind of help you maybe get a little better understanding from these different market trends. What's happening. So let's dive in. All right. So, after a positive start to the year, market sentiment has grown a little bit more mixed. Investors are really starting to shift attention away from the inflation fears that we had last year that the Fed was dealing with, and it's kind of moving toward concerns over the impact of the slowing economy, slow growth. And on corporate profits starting to slow down. So, early indications from our Q4 earnings seasons are that companies are starting to feel, the weight of weaker demand. And then, of course, we've seen rising labor costs. So, all that being said, we still continue to believe that the market returns will be better in 2023. But volatility is likely to continue, in the near term until economic and earnings data shows kind of signs of bottoming out. But these market trends we're going to look at today: labor, Fed, housing, budget deficit, inflation, and oil have a lot to do with this. So let's just dive into each of those real quick. So on the labor side, demand for workers is slowing. But that's following, really strong hiring during the pandemic. And so the need for temporary workers, and their wages has steadily declined. Now that's the temporary side. You're really seeing a lot of this play out in the tech sector. They've had a lot of layoffs, but a lot of those layoffs were temporary work from the demand push that went up during the pandemic. So that has been something that was, expected. The next thing, let's look at the Fed. So of course, the Fed's is increasing rate at a smaller increment than in the past in 2022, and this kind of buys them a little bit of time to see how rate increases are impacting the economy. So I think they're going to take a little bit slower. We should probably expect a quarter basis point in March, depending on economic data. They could go half a percent. That would shock the market a little bit. But I think they're going to take it slow and see what they, how what they've done, has really affected the economy and let things play out a little bit. The next big one is housing. Building permits have declined 8 straight months. Of course, that's indicating that future housing construction growth may be kind of tepid for this year. Now, sometimes that can be regional. So locally, we may not see that as much, but overall, we should start seeing that the housing growth should be a little bit slower this year. Budget deficits. Of course, we've all heard this all throughout the news. The U.S. Treasury has hit the maximum amount they can borrow, which was $31.4 trillion. Congress needs to, approve an increase in the spending authority. We all know that brings out, partisan politics. Hopefully there'll be a deal reached by the end of summer. That's really kind of the date that we're, this summer that we need to, I think before September, they're going to have to come up with something so we don't default. So, as always, this will be a really talked about issue, and both sides will be trying to make deals to get that done. On the inflation side, since June, inflationary pressures have declined. That's brought on, of course, by decreased energy and goods, but pricing pressure for services continue upward with some of the labor costs, some of the, not the part-time labor, but some of the ongoing labor costs with services has continued to stay high. And that's one of those things we've talked about in the past, being sticky inflation. Wages are very sticky, and they're hard to bring back down. So that's part of the inflation. You know, that's a sector of the inflation that will be very hard to bring back down. Are those, service sector wages. Then we look at oil. So we've seen energy prices have rallied in the past few weeks. That was around January the 1st. A lot of this has been brought on by China's economy kind of reopening from the restrictions that they had. So we should start seeing, as China continues to open, that's also going to affect the economy and affect some of these market trends. So this is just a kind of a broad overview of some of these market trends, and once again, I hope this will help maybe understand where we are. But we're off to a good start in the market, and we continue to see that by the end of the year we will have had a decent year in the market with what we know so far. So hope this helped. Y'all have a great week. God bless, and we'll see you next week. Take care.